Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next 25 minutes here on Options Guide TV. All right. Our trades are looking pretty good that we put on over the last couple of days. Luckily, we did not go out and trade Synopsys. It's only down a mere 200 points at this point in time. And then just like the marketplace, as befuddling as it can be, Cisco and NVIDIA are both up very well on the day. So for everything that Synopsys is giving up, Cisco and NVIDIA are trying to battle to the upside. Mentions on China. Once again, I don't know what goes on with China at this point in time. Some days it matters a lot, and the next day it seems like it doesn't. We are in September, in case you didn't know. Today's date is September 10th. It is a Wednesday. And the market just doesn't seem to care about volatility at this point in time. The VIX is just hanging in there. We got the SPX up a little bit today. We got the Russell up a little bit. We got the NASDAQ up a little bit. Even though we saw what happened with Synopsys, the economic data came out fairly strong this morning and reduced concerns about inflation. Looks like there's a very high probability that the Fed is going to cut. Now the question is, will that cut be 25 basis points or will it be 50 basis points? And that's kind of where we're leaning. And so the market has taken that as a positive. Stocks are up. Financials in general are doing like Goldman Sachs yesterday had a real big move up, but like I look at Charles Schwab and I see Charles Schwab is down a little bit today and Bank of America is down a little bit today. And then we have gold increasing that goes along with in the recessionary case. If you want to talk about that scenario, so what gold is just gone parabolic. And I'm going to trade gold. I'm going to do a trade on gold. I'm really liking the direction that we've had, especially in September and October, where we're just, a little bit, I don't know what to say, neutral on the market to bullish. And that's what these skip strike butterflies are doing. Our UNH trade is working out great. And then also our Starbucks trade. So went out and specifically looked for a trade where we could get bearish on the market. And that was Starbucks. And Starbucks is still struggling. There's a lot of issues going on with Starbucks in general. But I think I would take the trade off. We've done it. I don't know exactly when we put it on because I actually put that trade on in my portfolio. And I sometimes get a little bit confused as to when we did it on what show. So with that said, Starbucks is down today once again, and the trade is probably looking pretty good. So we'll look at Starbucks. We'll look at UNH. Let's start by going to the Tradier Pro software, and we're going to start with the first trade, the first paper trade for this week that I want to do for this Wednesday is on gold. And let's start by looking at the chart on gold. And as I mentioned here, let's zoom in, chop, 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 chop all the way across. And gold will have a tendency to do that, right? And then all of a sudden, boom, there it goes and has gone parabolic. Now, this is a lot of positive candles, one little downturn, and now we're kind of flattening out a little bit. So I'm kind of wondering if this pattern is going to continue at this point in time. So I want to do a conservative play, once again, on a shorter term basis, thinking that gold is going to settle down here for a little bit and see. I'm going to still lean bullish on it. And I don't mind if you want to flip it and go bearish with our butterfly. But it's more so, to me, once again, just like in UNH, we're going to be selling a lot of premium. We're getting a little bit of volatility, got a little bit of predictability, and you can lean to the downside if you want. But to me, I think the market's going to kind of stay flat or tread higher, trepidatiously higher, I should say. So let's look at our setup. Going to go out to the September 19th expiration. We're going to go a little bit in the money. So this makes our break even fairly close to where the underlying is at when it's all said and done. You take this number, this strike on the call side of things, and you add what we pay for it. So right now, I like it right at 350. Always dealing with live markets, but let's call it 350. I like that. the midpoint's right there. So finally, the market is working with me, and it actually went down as opposed to going up. I feel like the last, 5 or 6 paper trades that we've done, as I'm trying to set them up, the market is moving against me, making the fill worse. And it's just it's been a little bit frustrating. But with that said, my whole goal is I'm going a little bit in the money. We're still getting a lot of good premium here by selling the 342. Now, a lot of it is, first of all, GLD does follow the gold. This is one of the better ETFs in the commodity space as far as actually tracking the price of gold. It does a fairly good job of it. And, in other words, you can sometimes get ETFs that are supposed to track a commodity, and the commodity goes up and the ETF goes down. You run into that with some of the oil ETFs every once in a while. But in the gold one, if gold's going up, GLD usually goes up right along with it. They have some matrix out there, and gold is one of the better ones. So my goal is to set it up that if gold just stays where it's at, we're at least at break even. We drift a little bit higher, we're going to be doing a little bit better. And that's where we're at. We got 9 days. I think that we hit a topping point on gold. And I think the path of least resistance is really to kind of hang where it's at, and it may drift a little bit higher. So that's my outlook, and that's what we're going to set up. We're going to go in, and this is the call side of things inside the Tradier Pro software. And I'll scroll down here. This is highlighting where the market is at, fairly close to 336. We're going to look to buy the 332 strike call, and then we're going to go 10 points. Now, I made the math simple. I want exactly 10 points, but very liquid underlying, very easy to get in and out of these option contracts. And even the 1 point strikes, which is very weird to have on a $335 underlying, but they still seem to keep the liquidity. Look at all the open interest that we have, solid open interest across the board. Okay, the 19th is a Friday, 9 days away. Buying the 332 strike call, go to the 342, 10 points away, and then buy the 347, stopping short. I coined this as the open wing butterfly. Nobody's really coined it before. I like it better than a broken wing or a, obscure butterfly. I think open wing kind of sets the right expectations. So if we go to the what if calculator, I already have it loaded up in there. What I mean by open wing is that we buy this one, we sell something fairly close to at the money. Well, I'm sorry, a little bit out of the money in this case. When I do my OEX ones, they're always at the money. And sell something a little bit out of the money. And then if the market goes on up, this wing is open and it makes the trade profitable. So our only risk is to the downside. If the market drifted down below 332, then we would be down on the trade, and our maximum that we could lose is $3.50 or $350 per 1x2x1 butterfly that is executed. On the upside, no concerns. Now, ideally, we just drift a little bit higher and land right at the 342 level, and you'll see that our break even is right where the stock is at, and the profit and loss graph is doing a good job of tracking that at this point in time. Right, 350. You take 350 plus 332, that is 335.50, and that's where we're at right now. So we set this up that if the stock doesn't move at all, and we ride it all the way to the expiration date, which is 9 days away, then we would be at break even. Now realize that this is an ETF. And it's not an index, so it's not cash settled. So if you land somewhere in the middle here, you're going to have to do something. You're going to want to close the trade out, or else you're going to be buying 100 shares of gold at $332. So you're talking about a nice chunk of change to be able to buy that 100 shares of GLD. So just be aware that you do want to close it out, and it's a short-term expiration. To me, that is very intuitive, but I've found from some of the emails that I've received that sometimes people just forget about them and they don't trade them, and they get auto exercised. And if you have margin or if you have cash in your account, the brokers will just let you keep it, and they will expect that that is what you wanted to do if you don't get back to them. So with that said, Here's our paper trade. And I like this one. This is kind of a UNH trade. It's not much different in my mind. Some volatility, some predictability. We had a topping point, market came up. Now it's settling down, trying to figure out where it wants to go next. All right. So speaking of, well, that's it for the gold trade. And if you have any questions, please do put them in the chat box. I am happy to address them. I don't know what Tradier does a great job of making the video available on a ton of different platforms, but the easiest place to go to is just hub.tradier.com. Sign up for free and get everything for free. And it's not one of those head fakes either. You sign up and then we want you to pay it later. That doesn't really happen here. So yeah, check it out. There we go. All right. Good morning, Kurt. Anybody else want to say good morning? Go ahead and jump in the chat box. Let's get these good mornings rolling. Nice. All right. No questions on gold. So let's go back and look at our Starbucks trade. SBUX. Starbucks right now is down 87 cents at this point in time. We put on, we sold the 85 and we bought the 90 with the 10/24 expiration. And we sold the 85 and bought the 90. And I'm froze for a second here. Oh, on the call side, what am I doing? That's why that is weird. Sold the 85 and bought the 90. So we did this trade for 180. We're up 30 cents on the trade at this point in time. Well, good morning, everyone. Hello, Anthony. We are selling the 85, buying the 90. So we're 5 points wide. We're up about 30 cents on this trade. It's at 150. So there's two ways that I'll approach a short. This is a legit short call spread in that went out about 44 days, did some research, think that we're bearish overall on Starbucks, weak fundamentals. Chart even kind of shows that we broke down a little bit. So we got a couple of things going on. If you do short spreads, whenever you put that trade on, you always want to pick an out point. If I get half of the premium, I'm interested in getting out. But ideally, if I get all the way down to the point where I have 10% of the value. So if we do 10% of 180, we're talking about 18 cents. So I'm going to buy it back at 18 cents, no matter what. If it gets to that range, I don't ever want to try to hang around to try to capture that last 20, 15, 10 cents. But I'll think about it anywhere from 90 cents on in. And then also you want to manage your risk on the upside. Now, by going out further in time and doing in this instance, the October 24th expiration, right? We have 44 days remaining until that expiration date. And I do know that I chose this expiration because they do have earnings in November. And I wanted to avoid that earnings because we're selling premium. You don't want that pumped up implied volatility. I really like the setup for Starbucks. Even though it's a longer term trade and we don't always do longer term trades, 44 days isn't long in the whole scheme of things, but this was just a real nice setup for a bearish trade. Now, I hope I didn't jinx the fact that it's gone down, and I put this trade on. I've already put it on and taken it off. Honestly, I sold the 90.95. I already took that trade off, and then I repurposed it and did it on the show. So with that said, it gets down to 90 cents. Think about it, anywhere from 90 down to 20. That's the range that I want to take this trade off at. And on the upside, don't ever want to lose more than double, right? So if I did 180, then we're talking about 360 on the trade. So I'm going to want to close it out somewhere in that range. I don't like it to run against you. Some people will say, well, I'm going to put them on and I'm going to take them off. I'm going to manage the upside, but I'm going to let the downside go against me. I don't like that. I would rather close them, and I'd rather do them on a shorter term trade. And I do always like to sell them closer to at the money, bring in a bigger premium if possible, to manage the risk. To me, it's an alternative when you're very bearish on an underlying. It's an alternative to a long put spread. Selling an at the money short call spread and bringing in a bit of premium to help offset some of the risk is, to me, different than buying a long put spread where you need the market to move in order to at least get to break even. So I like this as that alternative. Okay. Lastly, UNH. So on the UNH trade, don't tell me I cut off. There it is. Okay. 9/12 is the expiration. Oh, we got 2 days on this one. All right. Wonderful. Underlying is at 310 to 325 and 330. So we're deep in the money on it. Is that it? Everybody, am I got the right expiration? We did 9/12, right? So we put it on last week at the beginning. You want to double check me on that? 310, 325, 330. 310. What just happened? Yes. So here's the way the trade looks in the what if calculator. Now, this is assuming that you paid for it today. It's $9.82. We paid for our UNH butterfly $1.17. No, that's not what we paid for it. We paid $3.50 for it. 1 second. $5.25. That makes sense. All right. So we paid $5.25 for it because I remember what I was saying. We want to at least make $500 on the trade if the market went up. So we ended up paying $5.25 for the trade. Right now we're showing it's trading for $9.82. The maximum that it could trade for would be $10. So it's 20 cents higher. Actually, right now it's at $9.95. It's almost at $10. So here's a great example of what do we do now? We've got the trade on, and UNH has had a strong move to the upside. Once we've been playing it, we've done this more than once, and now we finally had a breakout, and we're right at this area, right at 340. Do we fill this gap? Do we not fill this gap? We went out, we put this trade on. I think it was 9 days ago, also much like the trade that we just set up in gold. UNH, we put it on September 5th is when we put the trade on. $5.30 is what we paid for it. My problem is that my eyes aren't what they used to be. So $5.30 is what we paid for it. We got a definitely strong breakout. And the next question is, do we fill this gap right here? So I still think it's a solid play. If we go a little bit more at the money, we lean towards the upside to see if we're going to fill this gap to the upside and sell something more at the money. So I would adjust it a little bit more, be a little bit less bullish, be a little bit more like the trade that we have set up in gold. So here's our trade, $9.95. The question now is, if we look at the what if calculator, would you close this? You put it on for $5.30. You're going to make $4.70. Is there a reason to close? Now, here's the main reason to close. Exercise on assignment. The brokers are going to start freaking out because you have a way in the money option contract, even if you did a 1x2x1, that wants you to buy the underlying at $310. Now, you have the obligation you have the short option contract saying you're willing to sell it at 325. So you'd be buying it at 310, selling it at 325. And then you also have the 325 and the 330. Now, in a vacuum, somebody might just see the 310 strike call. And I've noticed this, especially if you're dealing with brokers that don't trade or that don't manage the risk on the options appropriately. You want to just close them out sometimes, right? But there's no reason to here. Why? Because on the downside, right now, if the market comes down and we land within this range, this profit and loss graph, which is based off of today's prices, remember that it's leaning a little bit more this way from where we did the trade. We're going to be a little bit more in the middle, but this is going to drift over the next couple of days towards the middle point, towards the middle of our butterfly. So if the market comes down, we could actually make a little bit more than $4.70. Maybe we could make $6. Maybe we could make $6.50. Now, our only risk, and this is a risk that could happen, is especially in UNH, the way the news cycle has been, is that some bad news comes out once again on UNH, and boom, the market blows down below our strike and we get burned that way. So the market gap on the open is your main risk, and we only got a couple of days left, right? So not a lot of people are looking at it. I would let it ride. And here's the moral of my story. If I'm going to do this trade and it expires on the 12th and exercise an assignment is a concern, I'm going to get out in the open. Your broker, and this is real life scenario, your broker, because I work for a brokerage firm, we manage risk all the time, but we're not going to start looking at that position on the open, right? You're going to get a little bit more nervous. If you're just looking at it as a vacuum and you're not managing the risk right, you're looking at that 310 strike call and saying you have an obligation to buy the stock at that. Do you have that capital to buy it? So keep that in mind. I would close it out on the open tomorrow. I would let it ride today, see if it comes back and gets back within the range. And then, well, I should say Friday morning, I would close it on the open and see if it comes back and gets within the range. And maybe you get a little bit more than the 340 on that trade. Anybody do this one, by the way? Kind of curious. Let me pull up the questions. Yeah, thank you, Anthony, for confirming. Yeah, that was a little bit. I thought that we did it last week. Once again, I'm doing so much content now, I get kind of confused sometimes. 9/12 expiry. Now, did you do the trade, Anthony? Did you already get out of the trade? But you guys want to set up another one? I mean, we can save it till Friday. I like the gold trade right now, but I like where the chart is at right here for a neutral to bullish trade. And actually, this is a golden cross, right, where you had the 20-day cross over the 50-day. Let's go back and add some days. Let's see where the 200-day is way below that, I think. So we still got a lot of room to run to get to the 200-day. But this is a positive, and we got this gap. Stocks usually want to fill gaps. Got out with only 200. Oh, that's all right, Anthony. That's solid. Nothing wrong with that. All right, let's set one up. Let's set one up. I still like I don't know. Ever since Warren Buffett drew my attention to it, and I do have UNH. Like, I own the stock. So I jumped on the Warren Buffett bandwagon, and I'll be blunt. I was actually looking at trying to catch that falling knife, and I was sad because I got in like a day after Berkshire Hathaway came out and said they're going to buy it, and I was looking at it and I had it and I didn't pull the trigger. Okay, so here we are. Let's pull the trigger this time. Let's do it. Let's set up another one. I like that time frame. Okay, stock's going to pay a dividend over the 9th. So the market will go down by the amount of the dividend. We got 9 days. Yeah, let's do it. Let's do the September 19th. And the dividend will affect the call prices. The bigger the dividend, the lower the call prices, because when the stock pays the dividend, the stock goes down. So if it's paying a big dividend, which UNH has a decent dividend yield, we can look at the chart over here. 220, 220. It doesn't have the yield in here, but yeah, a solid dividend. Oh, annual yield 2.76. So very good dividend. Means the market's going to go down by that amount, by the amount of the dividend that is paid. So let's keep that same ratio. Vols are up a little bit again. All right, so that should make this a little bit cheaper. Let's make it more at the money, though. This is going to cost us a little bit more. Let's go the 10 points. All right, got to get rid of that. Now, the official paper trade is the gold trade. But so once again, I'm going on a tangent because I like the way the chart looks. And go 5 more points up to there. 360, that's not bad. We paid 5. We went 15 points before. All right, that's what we did. That's too cheap. But I don't mind this one. 360, you're looking at 140. If you get it done for 360, you're looking at 140 as the max upside if the market goes up. A little bit more conservative. 338.60. So you're right in here where the break even is at. So the market can come down a little bit. 338.60 is where your break even is. So your positive time value in this trade, September 9th. Yeah, that's not bad. All right, let's send this one to the what if calculator. But the last one that we did was 15 points. All right. And we paid $5.30 for it. So let's look at the 15-pointer. And I once again want to be selling something more at the money on this one because I'm less bullish, but I still think it could break out to the upside. I mean, if it does, it's going to go hard, right? It should. Well, there's no absolutes, but it should fill the gap if you believe in charting stuff. 7, yeah. It gets expensive, right? But we can do the 350, 250. That gives us $3 of upside. All right, let's look at that. I like the fact that we got 2.5 point strike here. So then this would trade for 7.5 because you're 15, so you're cutting it right in 650. Ooh. I think I like our 10-point wide one better. Yeah. I like the 10-point wide trade. 340. Like your maximum upside here is 885. If the market doesn't move and it just hangs out here before it decides that it wants to go higher, and we drift down a little bit. I'm just gonna boycott the 15-point wide one. Here we go. This would be the trade. I like where the break even is at. Let's send that one to ticket. Let's pull this down, and you see this is where the market is at right here, 334. We're selling all that time premium. We're a little bit in the money, so our break even is where we cross this zero line right here. This is where our break even is at. I don't know why it's saying 536. So this is off a little bit, but this is where we're at right here. And so we got a little bit of room to the downside, actually quite a bit to come down. Yeah, I like this one. I like this one right here. There you go. That's a bonus trade today. If you want to keep in the UNH butterflies, I mean, we'll go back to the well and we can try it again. And let's look at the charts because we started messing with it right around here, right after the Buffett news came out. And the stock has behaved pretty well, and then we got the breakout. Yep. Any questions? I see I'm a 1 minute over. Any questions on any of the trades today? Thank you. Let people know about this, please. Send it out. Share it with your friends. This is free. It's never going to not be free, right? The Options Guy TV. Tradier is willing to sponsor it. They're putting their time in, and show them a little love. Open up an account with them. Let them know that you appreciate all that they're doing to try to educate the people that are out there. And we'll be back on Friday. I don't know what to do with Synopsys and NVIDIA and Cisco. Just everything is just a little crazy in the markets. Still expect a drawdown. Still September. And I don't remember exactly when we did the last VIX trade, but if we don't get the drawdown, probably by next week, maybe want to get long some VIX, get real long some VIX in October. All right. Thanks for stopping in. We will see you this Friday, 11 a.m. Eastern time for the next edition of Options Guy TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.